You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome back to Real Investor Radio. I'm Fuhr, joined again by Jack BeVier. Jack, how are you today?
Great. Good morning, sir. Great to see you.
In your remote dungeon, I see today.
Always you got to move the backgrounds around, keep the people guessing. You know, you can't dox yourself. You got to move it around.
Undisclosed location, as always. So, Jack, today I'm so excited to bring on our guest. We'll just start off immediately, get the conversation going. Real Investor Radio, always bringing you the legends in the industry. Today is no exception. Today we have on Bruce McNeilage. He is a 36-year investment veteran. Let me put my glasses on here, Jack. And co-founder of Kinlock Partners and Kinlock Homes. They're a Nashville-based firm focused on build-to-rent housing and single-family development across the Southeast, specifically in South Carolina, Georgia, Nashville. Kinlock has built in 9 area subdivisions, 5 in Nashville and others in Augusta, Columbia, Aiken, Greenville, and Spartanburg. Bruce launched the B2R business in 2005, and since then, his firm's assets have been acquired 19 times by private equity funds in reach. Kinlock builds homes for its own portfolio and sells to institutional investors and tenants alike. And Bruce has been featured on, and the company has been featured on NBC Nightly News, Wall Street Journal, Bloomberg, and New York Times, and local affiliates with CBS, Fox, and ABC. Bruce, it is an absolute pleasure. Really was looking forward to bringing you on. It was all my idea, none of Jack's on this one. So can't thank you enough for coming on the show, and looking forward to getting the conversation started. Jack, I was taking a look at the 5-year Treasury yield. We just passed the big, beautiful bill, and the bond market seems to be... what's the word that I should sort of not excited, Jack? I think folks are still looking at it and going, hey, we've got $36 trillion in debt, $2 trillion deficits for the foreseeable future. There wasn't any significant cuts in the budget. I think the country is going, the budget this year is going to be about $7.4 trillion. And that is definitely not pre-COVID spending. So give us your thoughts, Bruce. Feel free to jump in. Honestly, we're just a free-flowing conversation here on sort of where we're seeing the bond market today, Jack, and what real estate investors around the country can expect over the next several months.
Yeah, go ahead. Go ahead. No, get it.
I think there's 2 things we look at is 1, what are the interest rates for buyers, for home buyers, and how does that affect sellers and home buyers? 2, what are the interest rates going to be for investors like us? For Kinlock, we look more at the 5-year Treasury, and we're between 2 and 275 over the 5-year Treasury when we're borrowing. So the numbers still are not compelling, and we'd be looking at a negative equity situation on most deals if we were borrowing. For the 10-year, people are looking at approaching 7, right? 6.8, 6.9. And that's stayed pretty flat over the last year or 2. I mean, rates haven't really moved up or down. And I think a lot of people have been waiting for them to move down to buy. And we've been told buy now, marry the house, date the rate. People have been dating for a long time. And so I always tell people, when are you going to get married?
Yeah, when are you going to put a ring on it?
Right now, I don't know if people know when they're going to get married, but people have been dating the rate for a long time.
So like infamously amongst my friends, I dated my wife for 10 years before I popped the question, and we just had our 6-year anniversary. I only get credit for the 6, which I'm pissed about in retrospect, right? Because we've been together for 16 years. But yeah, 10 years was a long slog, though. I don't think that our real estate investments are going to be as forgiving as my now wife was about a 10-year dating period. So yeah, at some point, things are getting antsy in terms of dating that rate.
Jack, what are your feelings on the big bill that passed the House, working through the Senate right now, and how that's going to affect us over the next 6 to 12 months and possibly even long term?
Yeah, like it passed as of today when we're recording. It's the 29th. It passed the House a couple of days ago, headed to the Senate. But as you mentioned, there's like kind of like a mixed message coming out of the Republican side of the aisle right now, right? Like they've been like defending Doge attacks since the first 30 days of the administration, and yet none of the Doge or very few of the Doge rescissions were memorialized in this bill. So like that $150 billion didn't even get codified into a congressional bill when the Republicans have a albeit very, very thin majority right now. And I think that thin majority may be the real like problem, the issue.
Yeah, it
And
almost feels like the whole Doge thing was performative. When none of this stuff makes it into law, right? And frankly, they didn't even cross the Potomac and get over to the Department of Defense and make any significant cuts there. In fact, the budget for the Defense Department actually is now $1 trillion, up from about 900 billion last year. So didn't see any significant cuts there. Didn't see any significant cuts in Medicaid, waste, fraud, and abuse. And so I'm just starting to wonder whether or not Elon bringing out the chainsaw was really just performative, or whether it was something that we can expect to see in the future in terms of cuts.
Yeah, like who knows like what the conversations are happening behind closed doors, and I'm obviously completely speculating here. I spend time looking at houses, not wandering the halls of Congress, but the
One day,
tax
Jack.
cuts,
One day.
but the Trump tax cuts being made permanent, that seems to be like the big feature of this bill, right? So we get back 100% bonus depreciation. Otherwise, you would have seen significant tax increases on corporations and lots of folks. And so it feels like the trade-off was, hey, let's get these tax cuts made permanent. And I'm completely speculating here, but I wonder if the political calculus was get the what's one more year, right? Like we have such a big problem. What's one more year? If we can, with the super thin majority that we have right now, if we can get the tax cuts made permanent, we'll then start to hack away at the bigger problems. And the idea that we were going to like balance the budget, within 90 days of, the first term or first year would have been an extraordinarily ambitious idea. And maybe this is just what they think that they can get done, and they'll continue to hack away at it. That said, it hasn't come through the Senate yet. And the Senate, with their longer tenure, is allowed to be a bit more thoughtful, has the opportunity to be a bit more thoughtful and long term in terms of what they went through. And there's still some Tea Party Republicans, and it's a super thin majority right now, and even on the Senate. So there's still some Tea Party Republicans that are having none of this approach to the budget. So I think we're going to see some volatility over the course of the next couple of weeks and some because of some brinksmanship, because people feel that this was the platform that you ran on, and so far he's been in the Middle East. He's been dealing with the war in Ukraine. He's really not chimed in on this topic at all so far, which is, pretty uncharacteristic of him. So we'll see what game theory he thinks is appropriate over the course of the next couple of weeks here as the Senate tackles this.
Bruce, why don't you give us a background on, 35 years in the business. I always love speaking with investors like you who have seen good times, bad times. You lived and obviously figured your way through 2008 through 2010, 11. Talk about, give us a background on sort of how you got into the business and bring us up to speed on where you are today.
And by the way,
Sure, yeah.
Before you get started, Bruce is the OG of build to rent. Bruce was doing build to rent as a business model 10 years before people were talking about, before they coined the term. So like he's been doing build to rent longer than literally anybody, I think. So sorry with that minor diversion.
Yeah, so Barbara Mandrell sang a song. She was country before country was cool. I guess I was build to rent before build to rent was cool.
Yeah,
And
you were.
what's I didn't know I was in the build to rent business, right? I came up with an idea. I did one house. Next thing you know, I think the first year, and I was part-time, I had 57 houses. That portfolio was eventually purchased by American Homes to Rent. And so I was a banker for 6 months out of college, realized I didn't want to work for a salary. I then became a financial advisor. I did that for 24 years. And about halfway through my practice, started buying these houses. Again, 1, 2, 3 at a time. A friend of mine financed me. I used, OPM, other people's money. And that's when we started, doing the houses at a larger scale. And once I built up that portfolio, which, for an individual investor without any equity behind you, to have 57 brand new houses the first year was a pretty good accomplishment. Because again, I didn't know in '05 and '06 really what I had started doing. And then we got into duplexes, triplexes, fourplexes, got into apartment buildings, then apartment complexes. But then I really came back when we started Kinlock Partners in 2010. I really came back to kind of what I knew and where I started, which was build to rent. And we started doing that in Atlanta, both building but buying houses that were a year, 2, 3 years old and fixing them up a little bit. And we wanted to build a portfolio like I had done in Nashville. And within about 6 months, the big boys started calling. And we didn't know who some of them were, right? Because they were new as well. And so that's where we got bought out that many times is, in the early years, instead of building our own portfolio, because again, we didn't have any capital or equity behind us, and it was very tough to get debt, especially in Atlanta. We kind of became de facto aggregators for, the big boys. And it was easier to buy from us, brand new houses, fully rehabbed, a tenant already in them. And so it was a pretty sweet deal for them because they were just buying the things, cash flowing, right away. And we developed a reputation. And I want to say every single sale we made to an institution, that institution came back at least one more time to buy another portfolio. And for me, I think that was a compliment because they were buying repeatedly. So they were certainly happy with the portfolios and the houses we were selling. And I think a lot of that goes down to the tenant selection. In our business, tenant selection, I believe, is most important.
What did the margins look like back then for you? I mean, and what was it like to deal with these guys? Get a call one day, and I can't imagine it's fun sitting across the table from these types of sharks, right?
Yeah, so our cap rate was 24% gross. And what we were doing is we had an average of about $50,000 in a house. A lot of them were the models, the first 3 or 4 houses in a neighborhood. We bought most of them from Bank America or from Countrywide, who bought Bank America. And so here we've got 50,000 in a house. We're getting 1,250 to 1,300 a month for the rent. And there was no CapEx. I mean, once you maybe put a water heater in that was stolen or appliances that were stolen, the roof's not going to leak. People are in the houses, they stay for more than a year because what's better than a brand new house, right? You're not going to move out unless you buy or build a house or you're moving out of that city. And so, yeah, cap rates were just crazy. And we were able to sell with a lot of meat on the bone. So the institutions that were buying from us were really doing well. We needed that money to kind of keep, chugging along and keep financing our operation. But once we had one house and sold it, we could buy 2 houses. We had 2 houses and sold them, we could buy 3 or 4. And so that's really how we saw the business for homes. Now, in a lot of these neighborhoods, you had PVC pipes sticking out of the ground. You had vacant lots. The neighborhoods were already built. I mean, the roads, streets, the pools, the clubhouses. But it was like a bomb went off, and you were just stuck in time with all these pipes sticking out of the ground. We started buying finished lots that you could put a house on, pad ready, developed lots for $2,000 a piece. And my partner at the time didn't want to do it because it didn't create cash flow. And I'm like, listen, this is the time period in your life where you're going to make a decision and you're going to sit on a front porch one day and tell your grandkids how you got rich. And when you're buying lots for $2,000 a lot, or when you're buying brand new houses for $40,000, I knew there was only a window in time. Now that window in time stayed open a lot longer than I ever expected, but I knew there was going to be a piece in time where it was going to be like that, and we just tried to exploit that and do that as long as we could.
So I totally screwed that up. I was your partner, and we were like same thing, like limited capital. We were doing turnkey rentals in Atlanta. What part of Atlanta were you in, by the way?
Southwest which would not be the most desirable part of Atlanta.
Yeah, like Fulton, Southwest Fulton County.
Southwest Fulton, North Clayton. Yeah.
Okay, yeah. So we were similar neighborhoods. We were Fulton, Clayton, DeKalb, a little bit North Henry, South Gwinnett. Like didn't do enough in the north. Wish I'd done more in the north because the home price appreciation in the north was phenomenal, but the cash flow wasn't nearly as good. So That was like the draw. But dude, I remember we literally had a conversation. So we were buying like 30 houses a month at that 2011 to 2014 timeframe, and similar model, right? Like buying houses, fixing them up, newer vintage stuff, and then selling them to aggregators who were building portfolios. But we had to, right? We wish we could have kept them, but there was, like you said, no availability of debt. So we just ran out of cash, we just had to sell. And I remember having the conversation with Fred and saying like, hey man, all these pipe farms, like these things, we can get these lots for like super low. Like it's a levered asset. If we ever get above replacement cost again, that'll be these things can like 10x, and that's only
Yes.
a lot going from 2 to 20 grand. Like that's nothing. It's still way below replacement cost. And we just didn't have the damn cash to be able to sit it aside and like have it just being like, cash flow negative, right? Because you still got to like mow the lots and pay the taxes. And so we just didn't have
HOA fees as well. We
Yeah.
had, you buy a lot for 2,000, but you're paying a $50 a month HOA fee. You're going to have more in HOA fees and property taxes
in
than
that
you're going
lot.
to have
Yeah.
in a lot,
Right.
right?
2-3 years. Yeah. Yeah, but man, if that would have been, I know some guys in like Southwest Florida who did the same thing. Just started buying the excess lot inventory down there, the finished lot inventory, and man, they just murdered it.
Yeah.
But we just never. I was like, there'd be an argument from like a portfolio management perspective. We should take 10% of our equity and buy this like highly levered assets, right? Like buy land with it, because as just like a portfolio diversification thing, because if it pays off, it'll pay off huge. And we said, yeah, we should do that. We should think about that. And then we went back to buying rentals and never did it. And then lo and behold, that'd have been a killer strategy.
Yeah, and we looked at it two ways. We looked at it that we could sell these to builders one day, but that we could also build on them and kind of create our own inventory and control what we were doing. And so we ended up doing both. We built for some of the majors and flipped the houses, but we also built for ourselves. And then we also just held on to them. And like you said, 10x, XX, those just to home builders throughout Atlanta. I thought it would take 5 years. It was much, much quicker than 5 years. And, those lots right now are probably minimum worth $50,000. And that's just in the areas of town that aren't as desirable. But yeah, it was just a time in place that if you did it, it worked out. If you didn't, you just never see anything like that again.
That same phenomenon was happening in other places around the country. I got a call from a buddy of mine whose father-in-law retired from AT&T, had a big bucket of money, and he's like, hey man, we can go to Phoenix right now. And parts of Phoenix like Queen Creek, Apache Junction, Gilbert, like these places that were pig farms. And he's like, we can buy these houses that were built in 2005, 6, 7 for 85 grand at the steps, go in, put carpet and paint and some granite on the countertops and sell them the next day for 100. That was a great play until, all the money from California discovered the same tactic and stuff got bid up too high. But it was a great play for a while. But you're
The biggest problem is banks, conventional banks, community banks that we worked with would not lend the money. For us in Atlanta imploded. My lead bank, I was trying to borrow $19,000 on an asset that had sold for 200 that I had bought for $38,000. I literally was trying to borrow 50% of a price that had gone down 80%. I had money in the bank. I had other performing loans. That particular bank and others, I just could not get any money.
Well, hey, that's what the office investors are saying right now, right? They're talking about this building that they're that sold for $250 a foot last time, and they're buying it right now for $80 a foot and can't get a loan for 40. It's that's when the asset values, like there's a really opportunism there. So be interesting to see if that market plays out in a similar way or not.
The only problem with office buildings, and I actually looked at bidding on one, a $100,000 one in an office park here in Nashville, is you buy it, you steal it, you get a great deal, but now who are you going to put into it? It's 100% vacant or it's 20% occupied or whatnot. And the value of that asset is to have it leased out, right? So you're getting a phenomenal deal, but where you're going to create value is you've got to get a tenant inside that office building or multiple tenants inside. And that's the challenge right now.
I haven't seen I don't spend a ton of time on the office side. As you know, Fred Lewis and Dennis Cisterna have a company called Sentinel Net Lease that does office that works in the office space, or net lease space broadly, and sometimes that intersects with office. But it's still weird to me that I haven't seen like office rents reset. Like I would think that because of what you just described, there'd be folks who are coming in, opportunistically buying those, and then just undercutting the shit out of the market from an office rents perspective. Now I understand that TIs tend to go along with office leases, and that makes that equation very difficult. But I look at the asking rents on CoStar for like downtown Baltimore office space because we have a building down there, so I keep tabs on that market. And the office rents haven't moved since pre-COVID. They're the same as they were before COVID, despite the 30% vacancy rate in that market.
Why do you suppose?
Well, I mean, yeah, I understand like that they have to, they have to be above a level where you can pay for TIs and maintain the building, regardless of the price of the the price of the asset that you're getting. And I just don't think enough deals have transacted to what, there hasn't been enough sellers that have been, had their throats slit where they've forced to sell. Like we had on the resi side, 15 years ago, where there was just a tremendous amount of inventory available. You go to the steps and they were just, handing houses out for 20 grand at a pop. So that same phenomenon hasn't really happened in the office space yet, the forced seller side of things yet. Hey, Bruce, you mentioned, so you based out of Nashville and then you went to Atlanta for that period of time.
Yep.
Were you in multiple markets at that point in time, or just?
No, we really just, started in Nashville. We started Kinlock Partners, in Atlanta in 2010, 2009, 2010, which was just a great time to start it. And then after a while, things started drying up or the cap rates really compressed because now these houses are $150,000, right? And so what we did is we looked at a map and said, okay, let's go to Greenville, Spartanburg. And Greenville, Spartanburg was just virgin territory. There were no nationals, there were no mid-tier players. And when we went to Greenville and Spartanburg, we would get houses and we had no competition. We were renting them in a week, getting what we thought we would get or a little bit more, no concessions whatsoever. But again, now the big boys came in the market, which is nice. We got ahead of it and we started selling to the big boys. But then all of a sudden, it's hard to compete against them, right? So you're kind of one and done or two and done. You get into a market, you exploit the market as long as you can, but then, your customer becomes your biggest competitor, and then you've got to move on to the next town. And so we went an hour away to Columbia, again, virgin territory. And then we went to Aiken and Augusta, Aiken being a great town, really nice tertiary market, high growth town, a lot of things going on there. And so if you look at a map, we just kind of connected the dots from one southeastern city to the next.
And were you buying lots and building there, or were still buying houses that were like, recent vintage?
Yeah,
turnkeys.
we were doing everything, lots, CO deals, takedowns, built some, but we really started going more to the CO takedown because, Jack, I really didn't know the market. You go into Greenville, Spartanburg, you don't know the market, right? So you can really stub your toe on it. So we start off talking to builders, getting with builders, buying product, and then you can get into doing the other things. But I've gone into cities where you think you know the market and you don't. So we like to kind of test the market or go in. And once we test it, if it comes true and we were right, then we could start doing the 3 or 4 things that investors like us do.
Yeah, gotcha. When did you become where you had projects going on in multiple cities, and how did frankly, how did you manage operations for that? Were you traveling a lot, just bouncing back and forth?
Yeah, I was probably 50,000 miles a year in my pickup truck. I had to buy a house in Atlanta and live there part-time. Greenville, Spartanburg, Columbia were just hotel rooms. But yeah, I was on the road every week, at least 2 or 3 days a week, just looking for deals, kind of like Indiana Jones. I remember Atlanta hopping over fences, climbing through windows. We found an Escalade one time with really nice wheels on it in a totally vacant community. The entire community was vacant. There's like a gorgeous Escalade. And I said to one of my guys, go up and smell it. Is there a dead body in it? There were no dead bodies, but I'm like, man, somebody is watching this complex. And I'm getting out of here a lot quicker than we got into the complex. But yeah, we never found better than an Escalade, but we found a lot of funky things over the years. And there were a lot of people many times running out the back door when we were walking through the front door.
Bruce, I've told the story before where we were doing a house and we were just looking at houses in Phoenix. And, you never knew what the person was going to do. You see paint thrown on the walls and, things put down into the HVAC system, stuff like that. But this guy pulled his truck and his boat into the house. So he, the truck is now pulled, gone through the wall that is the garage, and the boat is still half in the garage, half in the house, sets the thing on fire and says, I guess, hey, bank, this is your house now. So
yeah. I have the all-time greatest story. It's a Friday. I buy a house, I have the HUD one, whatever. I get to the house, there's a young guy in it. He's starting to redo the house. I'm like, brother, this is my house. You're confused. He's like, no, 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 I just bought it. And I said, hey, here's the deal. It's Friday afternoon. I'm worn out. I said, you are younger, richer, better looking, smarter, whatever you want to do. I said, but what are you doing on the house? Well, he told me. And so he called me the next week. He goes, do you remember me? I said, yeah, you were the arrogant guy that thinks you owe my house. He goes, well, I just found out it's not on Hackamore Drive, it's on Hackamore Court. I said, yes, I understand that. I said, what have you done to the house? He goes, I've totally rented everything. He goes, I've done flooring, paint, new cabinets, new appliances in the kitchen, and I did a brand new HVAC system. And I'm like, wow, that's really nice of you. And he kind of paused for a minute. He goes, can I at least have a couple $1,000 back for the HVAC system? And I did give him a couple $1,000 back because I figured he'd trash the house or come back and steal it. But literally, the guy redid my entire house for me.
That is a story. Put that Gab note. Put that one in a soundbite. That's hilarious. Jack and I always love doing the stories from the edge, like the thousands of houses that he and Fred have purchased. They've seen more than they're just great stories.
I have a Word document on my desktop. It's called The Book, and it's just a bunch of notes to remind me of all the different chapters, the random stories.
Jack, I have the book, but it's in my head, and I'm Fred's age, so over time I'm starting to forget the book. At some point in the future, the book won't be written because I won't remember most of the stories. But I'll always remember Hackamore Drive. I will always remember Hackamore.
One of the things you said before we turned the mics on today was that you are the boots on the ground guy. Love that. And so what was it like, so you're learning new markets and you're out there constantly looking at houses. You're obviously raising capital, stuff like that. But what was it like just to go into another town, go into another state and have to find all the guys that were, the contracting help? That alone is a babysitting job, unlike any other.
Yeah, so I did something unique. I took a couple crews out of Nashville and then they were doing the work for me in Atlanta. So we had kind of a rotating thing where they would come in for 3 or 4 days at a time. They would leave, the other crew would come in from Nashville. And so I didn't have to hire new people. But finally, we got big enough that I needed more people. So you had to hire Atlanta people. And I don't want to say we got burned, but yes, you're kind of hurting cats. You're trying to get everybody to show up, everybody to do the right job. Sometimes they're walking on top of each other. Sometimes you have nobody show up. So yeah, you start to build kind of a Rolodex of who's a good sub and who's a bad sub. And you learn pretty quickly, what you're working with, and you just try to find the good ones and you try to pay them well. And what I did is I made them a little partner in each house. I want to say we were giving our guys a good wage, paying them well, but we were giving them, I think, $50 or $500 a house for every house we turned. So there was a real incentive for them to turn it quick because we would pay them quick. And 500 a house, if you can do 5 a week plus get paid, that's a real good living.
Hell yeah.
So fast forward, the build to rent space that you've been working in has matured a lot.
Yeah.
Of capital has come into this space, but then the rising interest rate environment has been a real headwind against that. Like, what's the roller coaster been like from your perspective over the past, I don't know, 5-6 years?
Yeah. So the last 12 months has been a real challenge, right? I mean, if you used to go to these meetings, Fred, Jack, that we used to go to, the wine was flowing and a lot of people were eating fillets. The last meeting I went to, we were eating little barbecue sliders and they had beer. So if that's a good indication of kind of how the market's gone, anything I've looked at best is break even, and really it's been negative. And because it's our own money, we can't go negative. We can't say, okay, we'll lose money for a year and then we'll make it up, 3, 4, 5 years from now. So for us, it's kind of come to a halt or just a little north of a halt. People are starting to buy again. People are starting to transact again, but they're looking for returns in the high fives, where we used to sell to the majors in the high fours. So our margins have really gotten squeezed.
And that's 25% difference.
Yeah, well,
high fives versus high fours is a lot.
Yeah, it's the difference between me making 50,000 a house and 5 to 10,000 a house, and you can't get the houses anymore, right? Or you have to gamble. Jack, we used to put 20% down. Now we've got to put 30% down. So you've got to put more capital. And to your point, that's 30, 40, 50% more. It's not just 5%. It's not just 10%. Basis points percent. When you go from 80 to 70, that's a much bigger deal as far as needing capital. And you start running out of capital quicker. Therefore, you start doing less deals. And so we are seeing some of the majors come in the market, but what they want to pay us for houses, we'd really work for free or close to work for free. So why do we want to go to work doing houses? If we're going to keep them ourselves, we'll lose money. And if we're going to try to sell them to institutions, we're going to make a little bit of money. So it's kind of put us in a stage where we've slowed down considerably. We want to crank the wheel back up. But like I said earlier, when are interest rates going to come down? We've been dating this rate for a while, and we've just kind of put things mostly on pause. And a lot of investors have, because of the interest rate environment.
So I would imagine that, if that market can only stay quiet for so long, right? Until people have to modify behavior, and then capitalism works it out for us, right? And so I would argue that if this market stays stalled or stays difficult, that eventually land prices should come down to accommodate that. So that, because there's somebody who needs to sell land, and it could take a while, right? Maybe they can hold on for a year or two, but in year 3, dad passed away, and mom's now got this 30 acres of land that she wants to sell, and she just is a seller at whatever market price is eventually, right? Like, are we in that adjustment period right now, or are you seeing any symptoms of that?
Think we're in a period, these big builders can't carry the land on the balance sheet, right? So they've got to deal with developers. And sometimes people don't understand what a builder and developer does. And most builders are not developers. But Jack, I think what we're going to see is a lull in the market in the next year, 2, 3 years. There's going to be a big shortage of finished lots in the market because people aren't developing them at the rate that they need to be developed. You hear about the million of houses we're short in this country. And so, yeah, people have to buy the land. The land does have to do a reset. I have not seen land do a reset yet. At some point, your point's well taken. It will need to. But right now, the lots are what builders need. And going into the future, the lots will, there's just not going to be enough supply of lots. And so right now, it's a mad dash to get the land, to develop it. But banks are tougher with money. Now they want to loan you 50% of land cost, maybe 50, 60, 70% of development cost. And a lot of people don't want to take the risk, or with higher interest rates, they're more worried about it. So they're going to pad their profit or pad what they're charging a builder, extra. And of course, you got to pay more for the land. You got to pay more to deliver the lot. And now you've got to pay more for the house. And so that's driving affordability, and it's making houses less affordable really throughout the country. Any place that we know of, housing is becoming less affordable, whether that's just buying the house or whether it's financing it because of the higher interest rates.
Yeah, let's dig in. I want to dig in, pause here for a moment and kind of double click into this, what you just talked about. There's a lot to unpack there. So you've got, say you've got a willing seller of whatever, an agricultural piece of land where a developer is highly optimistic that we could get this thing subdivided and turn it into 100 lots, making up a project. That developer is is generally putting that piece of dirt under contract, subject to the entitlement process, subject to
That's correct.
And then the developer says, you know what, I'm willing to put either an option price down or a deposit down or make option payments, while I also go fund the civil engineering to get this land entitled and cut up into 100 lots. And that can be a 6-month process, that can be a 3-year process, depending on where we're talking about, right? So the developer is generally funding that with equity. There's and kind of no money has changed hands right now, other than the developer just paying the civil engineer. But once they get that land, once they get that subdivision approved, and eventually there's a finite term to that option agreement or that contract to buy the land from the little old lady, they've got to take that that land down, right? They've got to actually close and buy that real estate. And you're talking about the debt that developer gets on to acquire that still raw but entitled land, right?
Yes.
And then so we saw, I would say, like, our experience was, 2021, people started, money was flowing, interest rates were low, deals really penciled very well. And so private lenders got a lot more aggressive on, and some companies got really big, specializing in that kind of financing, right? Where they were lending to those developers to do takedown of entitled lots, plus do the horizontal construction to get it to a finished lot state. Something that I've seen. Sorry, that was a long preamble. Something that I've seen is that those late 2022, 2023 vintage deals, a lot of those have gone sideways, because by the time they got to the end of it, now we're like, hey, we're funding the horizontal construct. We've finished the entitlement process, but now we have to go through the horizontal development process, and we get the thing to finish lot, and it's like, crap, interest rates are up, and as a result, that it's not that 4.5, it's not that high 4s cap, it's that high 5s cap, and construction costs is still up, and we carried the thing for a year and a half. And a lot of those developers, would-be developers, have just run into cash flow issues, right? Because they get to finish lot and the bid ain't there anymore, or they'd be working for free. So we've seen like certain private lenders that specialized in that space have a significant default rate, like 25% default rate on that profile of project. And I feel like that stuff's just working its way through the system right now, right? Like no one wants it yet. They all see the value in it. No one's willing to just like get wiped out on it, but they also aren't ready to actually go out of the ground and build the houses yet, because of the economics that you just described. That's what I've seen. Is it similar experience? Does that resonate?
I mean, you hit the nail right on the head. And so you have to tie up the land, right? Let's say agriculture. You have to get it entitled. I'm going to say that's a year, maybe 18 months, but usually it's about a year. Now you've got to get it entitled. So yes, now you have 60 days to close on the land. You are paying roughly $1,500 a lot. We would pay average to get a subdivision laid out. So now you've got 100 house subdivision, you've laid it out, you're paying the engineer, and now you're ready to go. One of the problems in areas we're in is sewer and water capacity. The cities, municipalities, counties don't have the sewer and water capacity, or they don't have the roads and the infrastructure. And so they're going to say to you, the developer, hey, we need this road expanded, or we need this park built, or we need this, or we need that. And I don't want to use the word shakedown, but you've got to put a lot more into a deal just to get it approved, get it entitled, get it developed. And a lot of times you're not factoring that in. Now that's going to become a pass-through, or hopefully for the developer and builder, it'll become a pass-through, but it's just more money out of your pocket, right? So it's the entitlement, it's getting the land the way you want it from a development standpoint. In Nashville, we hit rock. I mean, there's no part of Nashville where there's not rock, and rock could cost you millions of dollars. You kind of know it's under there, but you don't know how much is under there. Just to hire a machine called a rock crusher is $40,000 a month. Just to rent that machine to crush the rock. And you've got to first bring the rock out of the ground. And you've got to do that. Why? You have to put the sewer and the water pipes in, right? And so the whole process is taking longer. The A&D loans are still out there, but the LTV, LTC, what you've got to put down, that's all changed. And again, it's making the numbers. People are extending these contracts longer. And if I'm the farmer or the family, is, hey, I've had it tied up for 12 months. I might as well extend the contract another 6 months, because if I don't sell it to this guy, the next guy is going to tie me up for a year, right? And so I see a lot of contracts being extended at very reasonable, I guess, terms, or just, I mean, legitimate excuses. This is not, I don't have the money. This is the engineering, the entitlement, all these things are just taking longer.
Jack, as a debt lender, we do A&D loans. Have some great customers that we're doing A&D loans for. But like if they came to us and they were like, oh yeah, the municipality that I'm in wants us to widen this road that's not even in our development, or put in this amenity down the street because we're being, I'll use the term, shaken down for that. I mean, we're not going to lend on that stuff. And so now the developer, I would think, has to come out of pocket has to bring equity for that.
Yeah, they've either got to come equity out of pocket to pay for that overage, or I mean, if it's a big enough incremental expense that also demonstrably improves what the
That's
after repair value is going to be, then, it could be worth doing a loan modification and adjusting the budget from 3 million to 3.5 million. But if it's but if it's 100 grand, it's not going to be worth it to go through that whole rigmarole. And that's just going to be additional equity out of pocket. Yeah, I agree with that. I mean, we've got some good A&D loans and we got some bad A&D loans from that vintage of time. Like we got some stuff that good projects pencil well, just penciled great then and pencil meh now, and cash flow issues, right? You can't just hang on. This thing is not income producing, so they just can't hang on indefinitely.
100%.
No one thinks that it's going to be a bad project. 5 years from now, I am sure all of these are going to be totally great, fine, viable projects.
100%.
But over the course of the next 12 months, there's cash flow issues, they can't carry it that way.
Yeah, and it used to be you can roll that interest into the debt, right, into the loan. That's not as that now the banks want you to pay the interest every month. And so now you have to have reserves to do that. What we're seeing though is a lot of companies are just tying up land. They're just running all over a city, tying up this parcel, tying up that parcel. And what they're going to end up doing is spitting most of them out and then closing on the one or two that worked out as far as financials. And so you're just tying up land. If I'm the land seller, unless I get the entitlement, unless I get the engineering, and unless I put a bow on it and then take it to you, I'm going to let you tie me up. And I'm going to let you tie me up with very little earnest money. Why? Because you can get out of the contract no matter what. So whether you give me $1 million of earnest money or 10,000 or 50,000,
it's kind of meaningless.
Yeah, it really is meaningless. It's correct.
So Bruce, are you just sort of largely on the sidelines right now? Are you, or in the markets that you have, that you've really enjoyed? Are you looking for other markets that might be more opportunistic right now?
Yeah, we're not looking for other markets. I get pitched on Texas and Florida daily, right?
I bet you
And
do.
what you've got to say is if you're pitching me on a deal, I'm not the first guy, right? I mean, I appreciate you telling me you're a legend in the business or, you've been in build to rent forever. So we're bringing it to you first. It's almost
yet you who has been in the business for 35 years have never heard of them, right?
Well, yeah. And also one of the reasons I've been in business for 35 years is I don't believe I'm the first guy that they're pitching the deal to. And so it's almost like Kinlock is in the middle of the alphabet. Neilage is in the middle of the alphabet. And so I'm not the first guy. And I'll call, guys that I know, like the Freds, and the Jacks of the world. And they'll say, man, I was pitched on that last week. Or, I just got off the phone with the guy yesterday. And I'll call the guys out. I'll call them, hey, I guess Fred, passed on this. Or I guess, Bob passed on this. And they go, well, yeah, as a matter of fact, he did. I'm like, well, I'm passing on the hot potato the same reason he passed on it. So thanks for letting me know you thought of me first, but you didn't think of me first. I'm the higher fool, but you've got to get a higher fool than me to do the deal, right?
We see some
And if you're raising capital, there's an old saying: he spends money like it's not his or like it's not his own. And it's easier to make mistakes, or it's easier to kind of be a rogue when it's not your money, right? It's our money. So, I need the return on my money. But Will Rogers once said, my greatest goal is not the return on my money, it's the return of my money. And that's been hard to do on some occasions. And so if I have one deal that ties me up, that I've put all my eggs in one basket, the next great deal is going to come along, right? And so, no, we're staying in the markets that we're in. We're for the most on the sideline, but I'm fielding calls daily, forward takeouts, current takeouts. We just got a deal offered again. We're great. They're calling us first. They need to start doing the takedowns. Well, they want us to start doing the takedowns in July. And I asked them, is July of what year? And they said, well, no, July like in 6 weeks. Well, I'm pretty much sure that's a pivot. And I'm pretty much sure other people have spit that hook out. And it's just not going to work. If you're trying to dump something and get out of it, it can't be that good of a deal. So why would I want to jump on board of something you haven't been able to pitch or you haven't been able to close with other people than you've been pitching?
What's your take on how to, right? There's a little bit of how to time that market that you're inherently trying to do there. Now, just let me play devil's advocate for a second. If you were buying in Atlanta in 2011 and prices were falling and and clearly no one wanted this stuff, right? They were just giving, they were selling lots of houses, tons of short sales. You could get anything that was REO was on the MLS was already out, in retrospect, a phenomenal deal, right? But at the time we were like, I don't know. I just paid 20. They want 32 for that one, and I just paid 24 for the one down the street. And like I'd hem and haw and not buy the one for 20. I'd submit my $24,000 offer and like cross my arms and hold firm. And then today I look like I don't know what the hell you were doing. I mean, of course, everyone's always capital constrained, so that there's like some practical limitations there. But
Right.
at what point do you think, if you're still bullish on residential housing long term, at what point do you say, hey, you know what, the win here is just like getting these projects under control, because I do believe in the asset on a long-term basis? And like, how much of timing the market do you do versus being like, hey, we're at replacement cost, let's go,
Yeah, so I think the replacement cost is a big deal. Like for us in Atlanta, when we were buying those lots for $2, $3, $4,000, the replacement cost was somewhere between $25,000 and $40,000. So I know I'm not making a mistake. Now the mistake might be it's going to take longer to get out of the lots, but when you're paying $2,000 for something that you end up selling $40,000, it was okay if you stayed in the deal longer. I don't think we're at the bottom yet, but where I've made a good living, and I don't consider it genius, I consider it a lot of luck, is getting into a city, an MSA, or getting into a product, or getting into what you're doing, a subdivision or the type of asset before, again, it's kind of cool, right? Before everybody gets in it. Because once that pendulum swings back, it swings fast and it swings hard. And if you kind of are now trying to figure out, hey, what should I do? That thing's already passed you by and it's too late. And so, what I learned at a very young age, and I think this is sage advice, is I've never made a dollar, never made $1 when I sell an asset. I sell an asset today, I didn't make a dollar. I made it 5 or 10 years ago when I was boots on the ground the way I bought it. So you don't make money when you sell it, because people aren't going to say, Bruce, you're a great guy, I'll pay 10% more than it appraises for. I mean, they'll kind of pay you the appraisal, right? The value, but you're going to make the money the way you bought it, not on the day you sell it, if that makes sense.
Sage advice indeed.
You seen any so are you seeing any restructuring happen, or is it all like folks who you can tell are a little distressed but don't really want to take a write down yet, so they're trying to restructure without changing any of the numbers? Is it that we're in that phase of like scrambling but not actually like hands in the air, distress?
Yeah, that's a great question. I think there'd be two levels of distress there. There's bank distress. They don't want to take down or take back the asset today. They want to kick the can down the street to the next quarter or the next fiscal year or whatnot. So we're seeing a lot of those banks, they just don't want to take the asset back. So if they're just collecting interest, the loan is performing and they can keep the regulators off the back. The minute that loan stops performing, the minute the interest rates come in, they have to do something about that loan. As far as the buyers are also kicking the can down the road. You call it pretend to extend or fake it until you make it. There's a lot of people that, they can't pretend anymore. You can't raise more money from investors that are losing money. And it'd be hard to pitch an investor, hey, if you just give me another $1 million, I promise I'll give it back to you plus a return. So I am seeing things taken back. I'm seeing people stopping throwing good money after bad to keep things afloat. But I think the next quarter or two, you're going to see some great opportunities on things that are being taken back by people that just can't keep going anymore.
Yeah, so we've been in this phase where people are literally just running out of money, right? They're just
Yes.
like, they make their interest payment. The loan is current until it's not. And then the guy's like, I'm done. Like, I'm totally done. Right. Like you do see that. Yeah, that's unfortunate. I think you're right. I completely agree with you. I've seen, canaries in the coal mine of those kinds of situations. And it just feels like with a somewhat of an increasing pace, people are like, nah, I'm just spent. Like I'm literally, I have literally no more options. Like we've been talking for a year, but today I'm literally just out of cards to play. And that's
Yeah,
that's the time when behavior actually happens.
and
That's
I
when
would
deals
say
happen.
I've done very well over the years doing something that I think is kind of innovative. I'll go to the bank and say, listen, you have a non performing loan. You've taken back this asset or portfolio of assets. I will borrow the money from you and I will start paying on that loan. So now you take an unperforming asset or a non performing asset to a performing asset. That same bank is going to loan me the money to buy that asset, which is going bad with them. And so I've convinced some banks to loan me the money on the bad asset that they have, make it performing overnight. Now they have a performing loan. They've written it off to a degree, but all they've done is loaned a new customer money. And that's worked well for us over the years.
Is that largely like small locals and small regionals, or
Yeah, it's been more community based banks. They can't afford an REO department. They can't afford to have a lot of REO assets. So they even have a list. I'll get calls like, hey, you're on my list. We are taking this back next quarter. Is this something that you're interested in? And yeah, when you have relationships with those banks, it's great to hear from them because you're going to get great deals. And they know you could be the REO guy, and they don't have REO departments. They might have a couple bad deals, and then they know that you have a good balance sheet. They know that you have good financials. You might already have a loan with them, and they're very positive. They look at it very positive, loaning money to you because they know you're a known commodity versus just putting it out there on an REO list and fielding phone calls.
Hey Bruce, what's your perspective? Just like general sense. Like I know, like I'm not going to have data behind this, but like, what's your general sense of the banks that lend on these A&D deals that are not making it out of the ground, right? They're not actually getting fully executed. The developer makes his payments until he just can't anymore and it's just like out. And then the keys get tossed to the bank. The bank takes a little bit while to foreclose, depending on where you're at. And is when the bank comes to you with that deal, is the bank taking a loss? Like, do you think that the bank lent at a basis that is now below market? So are you, do you have to convince that bank about how much loss they're going to take, or do you just have to be at the front of the line and it would be nice to get a loan while you're at it because, hey, loans are on A&D deals are a little bit harder to come by as well. Like what's the strategy by and large? What's the prevailing strategy? Are these banks taking
I think
losses or
for the
just
bank,
getting in front?
for the bank, they're trying to break even. They know they're not going to make money, right? So they're trying to break even or write down as little as possible. Because even a big community bank, you take down an apartment complex and you write off $1 million. That's a significant write-off for a community bank, right? It's a rounding error for Bank America. And so a Bank America, a big money center bank's going to have larger loans anyways. They're not going to be writing off a 50-unit apartment building or 20 houses. They're going to be doing larger deals. And so you're getting a deal. They are willing to take a loss. They're not looking at making a profit. They're just looking at getting out as close to what they have in as possible. And I might be willing to pay more. I might say, hey, I'm going to make you a Sharky offer, but if you'll loan me money at 4%, if you'll loan me the full purchase price, which I've done before, I'll pay your number. And so the bank's kind of saying, okay, performing loan now, bad asset, he'll pay us X, but we've got to loan him the full, boat, or we have to loan him 80 or 90% of it. Loaning me 80 or 90% is better than having a 100% loan that's gone bad. I just need to be the first one in there with money, or they need to know, they need to call me first. And that's because I've executed first, or they know I have money in the bank. You show them a bank statement, or you're already banking with that bank. Yeah, I mean, it's the idea is not take a loss, but to get the asset off the books as quick as possible.
so given the current environment, are you just in equity raise position right now or looking for these opportunities coming? And then if you are, what's the general consensus amongst the folks that you're speaking with in terms of them wanting to put up?
So, Craig, I can tell you we're different. I've never raised $1 of equity in my life. I've just bootstrapped this thing. Now, we've gone to New York. We've done the dog and pony show. We have been offered equity. We've been underwritten by equity, both smaller and larger operators, very large operators. But it was kind of like one of these things, like if you work real hard, you'll only owe them a little bit of money. And I'm not looking to work for the man. So for me, it's always been I could make money on 20 houses, or I could make the same amount of money on 200 houses. It's a lot easier to manage that smaller portfolio and then sell those in the future. And so we manage everything ourselves. We've looked for equity. We have the ability to get it, but the deal's never been sweet enough for us, or it's always just been one-sided where we just weren't comfortable with who the equity provider is. And this is something else I've said and I've learned, and I think this would be for your good investors out there that are looking to grow. If I can't see myself fishing with you on a boat for a couple hours, just spending time with you, or if I can't see myself going to a ball game with you and actually enjoying your company, I'm not going to take your money, right? Because life's too short to deal with people that either you don't trust or you don't like. And there have been a lot of people in my life that I haven't wanted to go fishing with, or I haven't wanted to go to a ball game with. Let's just put it that way.
I'm with you there. I'm with you there.
Yeah, I think it's I'm interested in how the next 12, 24 months is going to play out from that perspective, because I think there's a lot of stuff that needs to be restructured on the resi side that hasn't come out. I think there's some over levered DSCR loans that I think are starting to come out. Like, I'm watching the DSCR delinquencies tick up a little bit. And then there's these two portfolios in Baltimore right now. This is totally an anecdote, but like there's like a 200 single family houses portfolio that's in the process of being foreclosed on right now in Baltimore, that were DSCR loans, just out of state investor, just over levered of them, and I guess couldn't operate. I don't know a lot of the details in the backstory, but it's like an interesting canary in the coal mine. You know, if it may be nothing, it may be just a complete anomaly, but I don't know. For me, it feels like a canary in the coal mine, for other distress to come. I think that's going to be our source of inventory, is kind of like the exuberance of 21 fallout, 21 and 2022 fallout.
This is not going to be 08 and 09 because people were speculating. They were spending or investing money they didn't have. They were borrowing money to borrow money. You are going to see, in my opinion, one of the greatest opportunities going forward in the next year. You can't say, oh, this is a great opportunity compared to 08, 09. But in my lifetime, in my career, which will extend X period of time, the next year is going to be a pretty good opportunity to buy assets. And if you remember what I said, you don't make money on the sell, you make money on the buy. If you can raise the capital, if you can get the debt, next 12 months are going to be where you're going to get rich.
Do you have a view on where rents are going?
Jack, I hate when you ask my question. Yeah, I mean, I was hoping that we could pivot to rents, because I was actually reading some of your stuff prior to the podcast today, and you had a pretty rosy outlook for rent increases over 2025. You still feel the same way about it?
Yeah, so rent increases certainly aren't what they were 2 or 3 years ago. And I think people really got addicted to, double-digit rents. You looked at these pro formas that said you'll be able to raise rent 10 to 15% for X period of time. Something else I always say to people is trees don't grow to the sky. I mean, sooner or later, you can't keep raising rent 10 to 15%. So we've been pushing rent 2, 3, 4%. But a lot of that is just to cover the cost of insurance going up or taxes going up, things like that. So yeah, we're able to push rents a little bit, but not what we need to. And I'm not looking to break someone's back. I'm not looking to make something unaffordable, because then you start losing tenants and you start having a vacancy rate that's higher than normal. So I'm looking to rent that house and make a little extra money every year, but it's nothing substantial that we were doing, 2, 3, 4 years ago.
Hey, can I press you on a question that I've never really gotten answered to my satisfaction? The expense ratio, the part of the pitch behind the expense ratio of build to rent is that they're brand new houses. Your expenses are going to be very, very low because it's brand new. There should be little to no maintenance. And so as a result, those pro formas for build to rent deals get presented at, 25, 30% expense ratios, when
Right.
my experience is like 40 to 50% expense ratios in older vintage houses. But when I break, so here's the part that's been unsatisfying for me. When I break apart the expense ratio, my expense ratio, repairs and maintenance is not the driver for my 40 to 50% expense ratio. It's the turnovers.
Yeah.
And it's the tenancy duration and the turnovers. And my thought is like, Whether the house is built in 2024 or whether the house is built in 1965, I'm painting the house on like every turnover. Like I have a very hard time avoiding painting the house. And that ends up being like the biggest driver for my turnover costs. And are you seeing, are you getting the sense that build to rent operators are actually seeing turnovers where you don't have to paint the house? Because for me, like that's the biggest driver. And if you still have to paint the house on the turnover, like your expense ratio ain't going to be 15 points cheaper based off of
Right.
this new vintage alone. I don't know. What's your take?
So in the markets we operate, like in Nashville, I'm running to about a 30% expense ratio. And the reason you are is you don't have to worry about the CapEx, roofs, water heaters, appliances. Now you need to save a little bit for CapEx, but specifically painting, right, that is one of the biggest deals. When you rent a brand new house, and you give it back to me, I expect it to be in the same condition it was given to you in. So 20 or 30 nails in the wall, that's not ordinary wear and tear. Little bit of wear and tear on the carpet after you clean it is normal. So what we do is we send out a letter about 45 days before someone's going to vacate, and we say, hey, here was the condition of the house. Here's the check mark, box, check the boxes of what you need to do to ready the house to give back. And we always communicate that we don't want to keep a dollar of your money. But if you don't do these things, we have to hire someone that will do them. And we'll waive off on anything if you use our preferred vendor list, which is really, we have a great painting company and they do things at a very reasonable cost. So about 90% of our turns are covered by the security deposit. We want to return the whole deposit, but a lot of times we're returning part of the deposit. And I've been in the multifamily business. The average tenant stays about 18 months in the multifamily business. I think in our industry, it's about 2.5 years. I mentioned that American Homes for Rent portfolio we sold way back when I accumulated those first houses. Shocking statistic, a third of the people that when I sold them, the houses were 9 years old. A third of the people had been there for the 9 years. A third of the people. So you think there was no turnover then. Now, when I get a house back from them, I'm going to give them all their money back because the carpet's worn out, the paint needs to be painted. So that's not going to be an issue. When they've been there for a year, that's something else. People stay longer in a newer house. That drives your expenses down. And really, the thing that's hurting us and changing that ratio, maybe from 30 to 35% in Nashville, is taxes and insurance. Taxes and insurance are not going down. Taxes and insurance are going up at a higher rate than maybe you can push the rents right now. And so that's going to drive your expense ratio up. But an expense ratio on a multifamily community is going to be higher than on a single family community for those reasons. Plus, you don't have things like elevators, dumpsters, lighting, pest control, leasing per se. A lot of times you don't have all those things, or you can have those things on a part-time basis, where in an apartment complex, you need a lot of those things on a full-time basis, or you have expenses that you just don't have in a single family rental community.
Are you how big is the portfolio that you own and you guys are managing? Is that the same number?
Yeah, so we're a smaller operator. We never want to own more than 250 houses. So once we get up there, I'm looking to have a liquidity event, say of 50 houses. Then we build it up and have another liquidity event. And one of the reasons is I don't want to go out and raise capital, right? So it's our own. So our business has to grow by taking one step backwards so we can take two steps forwards. But the portfolio is never going to get large. And that's really because of the way we run the portfolio. Now, I could get to 100, 1,000 houses, 2,000 houses, and still manage the company ourselves. But my problem is now I have a partner that's going to take a larger share of the equity. And so that goes back to I'd rather own 25 houses than 250, or I'd rather own 200 houses than 1,000. You can just make as much money owning 100% of a smaller portfolio. And that's what we've seen over the years.
You're so old school, Bruce. Love that.
You
So old school.
Are you just paying the cap gains?
Yeah, I've done one or two. But I can't do a 1031 most instances because I need that money to keep greasing the wheel. So I need the capital and I need my basis back so I can keep growing the money. And truthfully, when I look at 1031s or I look at these opportunity zone properties, I see people have a tendency of overpaying because they've got to do a 1031, identify it in a short period of time, close on it in a short period of time. And so people run around looking for 1035 opportunities and they end up overpaying for them. And I feel that the long-term capital gains tax we're paying right now is a really good deal. And you won't hear a lot of people say, hey, my tax rate is a really good deal, but we're at a very low long-term capital gains rate. And I don't mind paying it if it gives me the money to keep growing the business.
We started doing some OZ deals ourselves. But I looked for stuff that was like long term, that was going to take several years to do, because I didn't know how much cap gains I was going to have each year, right? And we sell some properties out of the portfolio, and because we've depreciated them a bunch, there's a taxable gain, or there's a recapture. Hopefully we've got some home price appreciation also, but like I certainly have to have a depreciation recapture. And so we have these cap gains that we have to pay. And I've got 2 OZ projects kind of like that we're just working on for like several years each. And we like each year just put more equity into them. So they're like very low leverage deals, because that's a bunch, all our cap gains goes into that stuff. We'll see if it works out as a strategy. I don't know. That's
The Baltimore,
if I
Jack.
owned an OZ deal, an OZ deal you have to keep for a long time. If I owned an OZ deal, I'd probably keep it forever or a little less than ever, right? Because of the way you buy it, again, the tax play on it. But I probably wouldn't be selling it in 10 days. I'm sorry, 10 years and a day. I'd be keeping it probably long term and just making it mailbox money.
Yeah.
Hey, but while we still have you, Bruce, I was wondering if we could just touch base quickly on some of the legislation that we're seeing in certain states around the country and
Sure.
at a federal level. Texas, Bill 33 proposes fines on investors with more than 10 single houses. Washington State, no more than 25 houses. Virginia, looking to cap assets at 50 million. Nebraska is trying to pass legislation. New York, Minnesota. And then at the federal level, there's several, the Stop Predatory Investing Act and American Neighborhoods Protection Act. I thought I read that you were a member of the NRHC. And so love to get your thoughts on, what Jack and I feel is like, hey, you got these state and federal politicians that are probably shooting for the moon right now, but they're just going to keep biting at the apple until they get something passed, right? And as a guy who plays in the space and has for a long time, what are your thoughts there?
That's an excellent question. I can tell you about a case in Tennessee, and yes, great organization to join. That's really our trade organization. You have to be a member of the NHRC. But in Tennessee, county by county, they can now take your single family rental neighborhood from a 25% assessment, taxing you at a 25% rate, now to a commercial rate of 40%. And so that's raising our taxes by 60%. And when I testified, I basically said this: you get elected on affordable housing, affordable housing, affordable housing, less crime, better schools, right? That's the three-legged stool a politician runs on. But I'm just going to pass that new tax or that increase in tax onto the tenant. So you're not screwing me, you're screwing the little guy that just wants to rent the house. And we just had our first notice for a neighborhood. Our taxes are going up about $80 a month. Let's call that $1,000 a year. We're going to try to or pass that along to the tenant. I now can't bump my rents up because I've just bumped it up to make, due for the taxes. And so, yes, I would say nationwide, dozens of states are coming after our industry. But I would just go back to the same thing. And the argument is, you want affordable housing. If people weren't buying those houses in 09, 08, who would have bought them? How do people rent a house if there are no rentals out there? And you're also screwing mom and pop. In a lot of areas, they're saying if you own 10 houses or more, or 10 doors or more, we're going to outlaw. I mean, my grandparents, if you want to subsidize your Social Security, you might own 2 or 3 duplexes. You might own 5 or 10 rental houses. And now you're going to tax me, just the guy that wants to live off of a little bit, of Social Security and some positive rent. And that's not good. And so all you're doing with all those changes, or most of the changes, is you're increasing the cost, or you're making it tougher on landlords to provide affordable housing. And so really who you're screwing is the little guy who's renting the house from you. So I will either have to sell my houses and dump them. If you make me have only 100 houses and I have 1,000 houses, I've got to dump those houses on the market. You're going to make me sell them after a certain time in a certain place. There are no buyers. I can't sell 900 houses in the Nashville MSA. So if I start dumping houses, now you screw up everybody's comps. And that further hurts, the American dream. And so I think it's a good buzzword. It's a way to get reelected. Let's go after these hedge funds. Hedge funds are ruining America. But you look at who owns apartment communities, insurance companies, hedge funds, private equity.
Pension funds.
For some reason, they're not going after multifamily operators, which are all owned by Wall Street, but they're going after the people that are providing these houses. And, I tell people, if you don't own a house, there's only two things you can do with a house. You either own it or you rent it. If you make it tougher to rent and it's more expensive to buy, what are you doing? What are you doing? And so I think a lot of politicians are trying to get elected or stay in office by, chasing the institutions away. But it's the institutions that have saved housing. In my opinion, it's the institutions that have saved housing.
Yeah, such a small percentage of the total ownership of single family housing too. It just seems like barking up the wrong tree. Like you said, good politics, but like not really going to make a meaningful impact. And certain politicians have you make that argument to them, right? Like I've made that argument to politicians and they don't like to hear that at all, right? They're like, if anything, that's like confirmation that they're like, no, but I want to screw you, right? Like I thought that I'd figured out the way to screw you. And you're like, you're not screwing me. Like, I mean, you're moving the goalposts, so I don't like it, but like it's just going to get passed through to rent. And so people are going to have to spend a higher percentage of their incomes on rent or consume less housing because they got to get a roommate. So I'm just a cog in the wheel here, right? Like I'm just a mechanism of the capitalistic system, but that just makes them even angrier, right? Because they're like, no, but I want to screw you I want to screw the landlords in favor of the tenants. At least that's a political view that I encounter in our jurisdiction.
Yeah, it's just, it's not the right thing to do. It's coming. We're fighting it. There's going to be compromise, but at the end of the day, it's not going to help the guy that needs to rent the house.
Yeah, rent control becomes kind of like the, if you really, if you really want to go after the landlords, right? That, when you do rent control, that's essentially, in my opinion, that's a taking, right? Like we're in eminent domain land there, right? Because you're affecting the nature of my property rights. You can't just arbitrarily put deed restrictions on my real estate. That's a taking. And so it's hard to get done because you get so much pushback. Like every landowner understands that that's a taking and fights back on that. And so only in the most kind of extreme jurisdictions do you have rent control. But I've got, but we've seen down 295 from me in Prince George's County and over in Montgomery County, some very, very, very blue parts of Maryland. That's, normal political conversation. And, I'm sure you would agree that the effects on property values throughout that entire jurisdiction are significantly impacted when you do something like that, when you do a taking like that via legislation. But that's the thing that is trying to hold the line so that doesn't become part of an actual real conversation is the thing that that's the only thing I'm really concerned about. Otherwise, I generally take the view that you did, that I'm just hey, I'm just a cog in the system here. You raise the costs of operating real estate, rent goes up to pay for the costs of operating real estate. What do you want from me?
Well, it's also the NIMBYism, right? We haven't talked about NIMBYism. So you've got the government entities coming after you, making it tougher for you to develop or build or own rental houses. But then you have the people that say, not in my backyard. And I always tell people, it's not in your backyard until someone offers you $1 million more for your property. And then it's okay to be in your backyard, right? Because you sold it for more. And so, not in my backyard. I'll tell you another quick story. I was in Loganville, Georgia, east of Atlanta, and I'm buying this neighborhood. It's PVC pipes. It's half built, busted out. And Bank of America's not paying the HOA fee. So I come in. Property values are going to go up. I'm going to build houses. And one older guy stands up. I don't want to hear noise. Your houses are going to create noise when they're constructing them. And I said, sir, let me ask you a question. When they built your house, did it make noise? Did the builders make noise? And he thought about it for a minute and he said, yeah, but I wasn't around to hear it. Well, that's a NIMBY, right? And I said, I'm going to increase your values. Oh, but that'll increase our taxes. And I'm like, you're right. It's going to increase your taxes because I just made you wealthier.
By 100
Pe-
times.
People don't think. I've been at a meeting of an HOA where someone says your people are going to ruin our neighborhood, and I said, well, sir, who are my people? Tell me who they are. Well, he got quiet. I said, I have 3 houses on the street. One's rented to a tight end for the Tennessee Titans. One's rented to a cardiologist, and one's rented to a thoracic surgeon. Which one of those people is going to create crime or make the neighborhood better? As a matter of fact, those people probably make a lot more than you folks. But please don't call them those type of people. And I would like to say that doctors don't create more crime, and they stay here and they're good citizens. And that's the way, that's the way our people are. You can always take the bad story about the party house or the house that a hedge fund is not taking care of, but they don't talk about the 99 stories about the teacher that was able to raise her kids in a school district that was better than the district maybe that she could only afford to live in. And so it's our job. The NHRC does a good job in painting the picture, giving the narrative, and telling the positive stories about what we do, but it's a lot tougher to get that positive story out than to be negative. There's an old saying in television news or in the newspapers, if it bleeds, it leads. They talk about the bad stories first, but if you help the little old lady cross the street and save her life, that's on the back page, or they don't even talk about it. So we need more positive press and not negative press in our industry. And really, that's all of our jobs, right? That's everybody's job.
We had David Howard on the show several months ago. And for those of you who haven't had a chance to check out that episode, they're doing great things at the National Rental Home Council. I believe that's nrhc.org. Could be wrong about that, but look them up. And it doesn't matter where you are in the country, you can start your own chapter. They are a phenomenal organization that are perhaps the greatest advocate that the country has for landlords, big and small. You don't have to be, a BlackRock to be one of their members. You can just be a mom and pop who owns 10, 15 houses, and you care about some of this crazy legislation that we're seeing across the United States right now. That honestly, Bruce, doesn't appear like it's going away anytime soon. No, sir. Jack, any final thoughts so we can let this gentleman on his way? He probably has 10, 15 houses to go out and walk through today. So.
Yeah, no, we really appreciate your time, Bruce. Enjoyed the conversation. Looking forward to seeing you at the next conference, too.
Absolutely. Nice talking to you guys. And it's a real honor. Thank you for inviting me.
Bruce, if folks want to find out more about you and Kinlock Partners, you have an amazing LinkedIn page. I would tell folks to look up Bruce McNeilage on LinkedIn. Where else can they find you?
Bruce at kinlockpartners.net is my email. If anybody needs help, it's KINLOCH partners.net. And you can also check out our website. It's kinlockpartners.net. Talks about what we're doing. You can look at the assets we have to get an idea on what we're doing and the quality that we provide people. And I also post some articles that I write on LinkedIn. We also post them on our website as well.
A true OG and legend in the industry, Jack. And Bruce, you're welcome back on the show anytime you want to come, sir. Just send us an email and we'll make space for you. It's just been such a pleasure to have you. That's the episode for today. Coming up on, Jack, I think we're coming up on 100 episodes soon.
We're getting there. Yeah, we're
going to have to do something crazy for that. That's Real Investor Radio. I'm Craig Fuhr with Jack BeVier, joined by Bruce McNeilage. Thanks for listening.